Hello, everyone. Thanks for joining today. As before, the call will be led by Jerome Stern and our CIO, Chris Rosbach. We already have some good questions, but please do send more if you wish. I will now hand over to Jerome.
Thank you, Sandy. Please let me welcome everyone to our fourth 2025 WorldStars Global Equity webinar. After 5 years of webinars, the team and I wanted to thank everyone for their interest, confidence, and your relentless engagement. Our objective today is to update you on our WorldStars strategy, discuss key topics of interest, and to answer any question you may have. We look forward to a great update and conversation with Chris. As ever, a reminder for our newer participants. We're an independent asset manager with $2.5 billion of assets under management on behalf of institutions, endowments, wealth managers, trustees, and families, 20% of which on behalf of my family, the partners of the firm, and employees of the firm, providing investors with a powerful alignment of interest. We manage 4 investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our sole mission as a firm is to deliver strong long-term returns on behalf of all our investors in a disciplined, repeatable, and rigorous manner. Our flagship investment strategy, WorldStars Global Equity, represents $2 billion of assets under management, of which $442 million in our Luxembourg UCITS and another $590 million in our Delaware LP fund, available to eligible US investors. WorldStars invests in a concentrated portfolio of quality global stocks for the long term. This conviction-led approach leads to a high active share, low turnover portfolio, which has delivered 12.7% per annum net of fees in US dollar and 14% per annum in GBP for the past 10 years, with controlled levels of risk. Gross of fees, this equates to about 220 basis points per annum of excess return. This performance builds on the quality of our investment proposition, the stability of our investment team, the repeatability of our institutional investment process, and WorldStars' available investment capacity. Let's move on to how do we define quality. As many of you will have heard, quality is for us the defining condition for us to invest in a company. We define quality as strong and sustainable market positions, operating in good and growing industries, led by great management teams with strong track record of value creation and good corporate governance, and strong balance sheets to weather any type of adversity. We scrutinize those criteria through deep qualitative and quantitative analysis in a disciplined manner, making this the cornerstone of our investment process. If a company does not fulfill these criteria, we will just not invest. And that at any price. Quality comes first. At the end of the day, we want to invest in enduring, high-quality companies with powerful business models, higher growth profiles, proven resilience, enabling us to protect and compound capital for the long term. The key reason is that quality companies not only endure in uncertain and volatile environments, they get stronger. Quality matters. So our definition of quality leads us to invest in 4 key industries. Digital transformation, which represents today 44% of the strategy, consumer, about 16%, healthcare and life sciences, another 16%, and lastly, industrials and infrastructure that account for 24% of the strategy. By the way, we're overweight in those, which is a key differentiator within the quality growth universe. Similarly, our relentless focus on quality makes us avoid balance sheet-driven financials, regulated businesses, resource-based industries, as well as capital-intensive businesses. Chris, over to you.
Okay, thank you very much, Jerome and Sandy, and welcome everybody. I just want to talk briefly about the investment team, again, as a way of reminder for those who are joining us for the first time. Those of you who've met us are well familiar, but we have a global investment team based in a global city like London, looking at global stocks. The 4 senior members of the team, Katerina, Zishin, Giles, and I, have been working together for over 10 years, and we're all partners in the firm. So the alignment that we have from that perspective as well, we think is very important. We're supported by a talented team of investment professionals, both on the stock analysis, on portfolio analytics, as well as on ESG analysis that we do. And as Jerome highlighted, we do, as you know, all the work ourselves, the qualitative work, the quantitative work, including the financial analysis, but also the ESG analysis that flows into our investment decisions. And we think the overall long-term focus that we have, the partnership that we offer, the experience that we bring to bear, and the diversity of the perspectives leads to more robust discussions and to better decisions on behalf of our investors. If we move on to talk about the performance and the update, we're providing here information both on the year-to-date as well as on the month-to-date performance for the WorldStar's global equity strategy. It's had a very, very solid year in absolute terms, as you can see. The strategy is up as of October 17, 12.3% year-to-date. That's 4% in the last 3 months, and month-to-date 1.2%. These are the net numbers, net of the 1% full fees that we charge in the fund and other vehicles. We're also providing the gross numbers here, which are relevant for institutional investors. It's 13.4% gross, as you can see, 4.4% for the 3 months, and 1.3% on a month-to-date basis. That is something that we have to acknowledge is different in US dollars than in pounds, euros, or Swiss francs this year. It's been a year of great dislocation in terms of the currencies, with the dollar depreciation that's taken place as a result of the policies that President Trump and his administration have been putting in place. And so in euro terms, as those who follow us in euros know, is basically flat now year to date, which is an achievement given the exposure and the significant currency move. And in pounds, it's up 5% on a year-to-date basis. If we look at what that means on a relative return basis, then you can see we have very strong long-term returns. We've highlighted the 10-year return of the strategy, in which we have significantly outperformed the MSCI World and the MSCI ACWI, both on a net full fees and on a gross basis. But we've had a more challenging 12 to 18 months of relative performance, as our portfolio has underperformed some of the very factor-driven markets that we've had. We're going to provide you with some more detail in a moment, but we had started the year with outperformance, which over the long term we clearly want to achieve, but have had this challenging period in which we've underperformed. That has now started to reverse, as we've been expecting and as we've been saying, that our portfolio of global quality companies that have a significant growth potential ahead, and that are either reasonably valued in our perspective, and therefore should be able to benefit from that growth in revenues, in earnings, and in cash flows, or that are trading at significant discounts, in some cases 20 to 40% or more, both to our absolute valuation and to their long-term trading ranges, makes us believe that the portfolio is very well positioned, not just to perform in absolute terms, but also to resume its outperformance. And so to move on to talk about the stock selection, this is a graph that we have shared over the years because we think it is important. It's part of our monthly portfolio analytics that we look at, and it shows you the active return the factor-based return and the selection effect, or the alpha, that we've been able to deliver. The active share continues around 84%, and the overall exposures that we've had to different factors have been very stable if you look at it over the last 10 years. While clearly there's been some fluctuations, in aggregate it stayed within a very consistent range, in line with our approach of investing in quality, applying the criteria and the valuation discipline that we have. But what you can see here, and it really is quite remarkable, is that the returns over the last 10 years have been driven entirely by stock selection. So the factors you can see can be helpful, and of course we have certain factor exposure because of the types of industries and companies that we like to invest in, led by the quality, and the ones that we avoid, led by the quality criteria. But we're at a moment right now where the factors have been completely neutral over the last 10 years, and in fact they've gone against us over the more recent period, which is something that I've highlighted, whereas you can see that the stock selection has actually remained flat, positive in aggregate throughout the period, and it is obviously a bit of an eye test. If you can look at it, I can just about make it out. You can see that there's a very nice uptick that has taken place just in the most recent period, the last week or two, based on some of the stronger than expected underlying results in some of the consumer companies that we'll talk a little bit about in a moment, that have increased our conviction in the fact that what we're looking at there is a cyclical issue much more than a secular one, as I think is being priced in by markets. But this point about the stock selection is extremely important to us, because when we see the stock selection going down, even when it is on this longer term chart over some period, it of course allows us to say, well, where is the problem? Where is that stock selection issue coming from? And where should we redouble our work to make sure that the analysis that we're doing is in fact underwriting the quality and the investment cases of the companies that we invest in. If we move on to the next page to look at the 2025 year-to-date returns, again, this is the most recent data. We're providing you the top five and the top and the bottom five, but you can also see here by color code the underlying drivers of the stocks that we've got in the portfolio. You can see the overall 12.3% return in dollars. But what I think is really important, and it's, I think, very consistent what we've been saying over time, is just the sheer diversity of the companies in the portfolio that have been able to contribute. As Jerome highlighted, in the way that we classify digital transformation, it's about 44% of the current exposure, but that includes stocks not only like NVIDIA and ASML, who are effectively on the hardware side of supporting the demand for computing capacity, includes the big platforms like Amazon, like Alphabet and Meta. It includes software companies, but it also includes companies like American Tower. Amazon is classified, as we know, in consumer discretionary. American Tower is a REIT, so it's in real estate if you look at it from that perspective. So we think looking at it on an underlying basis is critical. But as you can see here, it's a very diversified set of companies that have contributed. Amphenol, one of the leading US industrial companies in connectors, benefiting in part from the investment in AI, but also into electrification and automation. EssilorLuxottica, the world leader in sunglasses and in lenses for vision correction. ASML, recovering after a period of more challenging performance as one of the key equipment providers to the computing capacity and need for capacity for semiconductor manufacturing. RTX on defense, we'll talk about that in a moment. And then NVIDIA, our largest position that has been a strong contributor, but as you can see is not the main driver this year and doesn't need to be from that perspective, at least in terms of how you look at the returns that it has generated. If you look at the stocks that have provided more challenging performance this year, you recognize again quite a diversity. You see Salesforce there, you see Diageo, the consumer company, still based on concerns around consumer spending and alcohol. You see Alcon, the leader in vision correction for cataract surgery. and implants. So again, a shift, I think, where it has been very much driven by underperformance by consumer stocks this year and outperformance by others. We'll show you some of the numbers, but a much more diverse picture. And if you look at some of the pink lines further up, then I can tell you that the two pink lines among the performers, and this is in dollar terms, are Nestle and L'Oreal. One of the issues that we've had with the consumer stocks we own is that we think some of the European ones are among the leading global consumer products companies. We prefer them for the very most part to their American counterparts. And so clearly their translated earnings in their local currencies, whether it's the euro or the Swiss franc, are going to be lower. So it's all the more remarkable to see them starting to perform off the very low valuations that they've been in. And we're very happy to see this dynamism in the portfolio, which we think is clearly contributing now to the performance, to the pickup in relative performance, and to the picture going forward. If we move forward just to an attribution analysis, LTM, just to put some more data onto this. This is on a last 12 months basis. So it really shows you the period of underperformance compared to the MSCI World and the MSCI ACWI. And I think you can see here very clearly where the culprits are. One is it's effectively what you could call the Trump trade, or the value trade, the revaluation of stocks at very low valuations that I think can be defined as value, that are solidly in the types of companies that we look to avoid. That is financials, that is energy, that is utilities as regulated businesses, and within industrials where you can see a negative number on selection, that is some of the more capital intensive businesses, as well as the very defense-heavy businesses that have performed very strongly. We own RTX. We'll talk about it, but we think, that is the primary direct defense exposure, and some of those have performed very strongly. We think that that is a trade that has taken place. Those valuations have now normalized, and so while it's been a source of underperformance, we think it's effectively done. The other area that you can see here as a negative number is consumer staples, where you can see it's a combination of the allocation and the selection effect over the period. That is something that as we've been highlighting, is one of the key areas that we've been redoubling our research, but we are convinced that we're at the point of turnaround. And as I think we've seen some of the results that have come through that have led to double-digit share price increases in some of these very lowly valued companies, I think highlight that patience is required here, but we're getting to the point where there's a real turnaround and opportunity. If we then turn just to a page looking at the outperformance, just to make this argument that you have heard us make, if you look at the 5-year rolling periods since inception of the strategy in 2012, you can see that we've outperformed in 78% of these 5-year rolling periods. We're in one of these outliers on the bottom right now. And to us, of course, given the complete alignment and consistency of the investment process, the team, and the decisions that we're making, we think that this is, as it has been in the past, a time of opportunity for long-term investors to look at the types of companies that we buy, to look at the strategy we have and the approach, and to recognize that it's very much a time of opportunity. And then to highlight where we are in terms of active weights by stocks and sectors, I think it's another interesting perspective. We've talked about the exposures that we have by our own classification, but if you look at it on a GIC sector basis, then you can see that the areas where we are overweight compared to the index as part of our portfolio analytics are actually very conservative. It's healthcare, it's industrials, it is communication services. If you add that up to information technology, we're very slightly overweight the overall sector, and it's consumer staples. So it's by no means a portfolio that is overexposed to IT or to tech. On the contrary, it's the individual stocks in the selection that are benefiting from the best of those companies at the right kinds of valuations, but it is by no means overexposed to those areas. It's diverse, and we think that is a strength, and it will be even more of a strength going forward. And if we look at it on the right-hand side on a stock-by-stock basis, we've just given you the top 5 here, then you can see Eaton and Amphenol, two industrial companies in dark blue, are actually the highest active weights, followed by Essilor and then by MasterCard and NVIDIA. So that I think is key, but as you can see, even though NVIDIA continues to be our largest position, and we're optimistic about it over the long term, you can see it's not our largest overweight, and actually, given the significant size it has in the overall index, it's a relatively moderate position compared to some of the other differentiation that we've decided to incorporate in the portfolio. If we then turn to the active trades, we know that we have a very long-term approach. We have an investment horizon of 5 to 10 years. We want to hold stocks if we can for 25 years or longer. We don't always, and we can't always, because in some cases the valuation moves, and we have to adjust positions on the basis of our valuation discipline, and we do that on a very regular basis as part of our investment process. It can be because of risk management, because positions in particular get too big, which is something we've had to do with on Amazon and Adobe a number of times over the last couple of years, and we've had to do on NVIDIA as well. Or it's because there's been a change in the investment thesis, and we want to reallocate the capital to other ideas, which also happens, as has been the case with Becton Dickinson, and most recently with Adobe. I think one thing you can see here, and that's consistent with what we've said, is that we've been able to sell stocks that we classify as being part of digital transformation, in part because of portfolio and risk management, in part because of valuation, to effectively trim positions in recognition that stock prices have moved and that valuation upsides are not as high as they have been in the past, or that they've been at the inception of the position, but then moving to reallocate that capital to both existing positions that we think are undervalued and to new positions like ICE, Intercontinental Exchange, which we added in the fourth quarter of last year, which had been a very successful position. This year it's now retraced a bit, but we think it's a real opportunity. Or most recently, when we took a decision, and that was based on trimming some positions, and most recently over the summer in Adobe and SAP, where we decided to sell the position in Adobe and to buy a position in SAP, the leading German IT and enterprise resource software company. So just to move a bit ahead and provide you some of the detail on this most recent trade. In terms of Adobe, it's been a very successful position for us since we first bought it in July 2025. It's the leading software company for image-related applications. We, again, first bought it in July of 2025. As you can see, we've had a consistent track record of trimming the position on position sizing and on valuation at different times over that period. So we've more than realized the initial position sizes. Reminder, we buy positions equal weight, and so we've more than realized effectively the capital. Over the time frame, you can see we owned it all through the pullback, the 2022-2023 pullback, when we were arguing very strongly that it was a cyclical and factor-driven response in markets to the rising interest rates that led to that volatility, and that it was a real opportunity for us in absolute and in relative performance terms, in exactly the same way that we're making the argument now. You can see we then trimmed it again, I think realizing some profits, but we've now decided to sell it. You can see we arguably could have taken that decision 6 months ago and would have done somewhat better. We do think now the investment thesis has changed, as we're highlighting here. While we think that over the long term, Adobe's business will prevail and it will be in a strong position, in the shorter and medium term, it is being impacted by AI entrants. Not just by new apps from startups, but also by applications by some of the large digital platforms that do pose a threat to Photoshop in particular at the lower end of the applications, the more retail and entry-level type of users, but it is clearly disruptive. We had thought that the way that Adobe was incorporating AI was actually very successful. The fact that they were able to use it on their existing photo library, and therefore it would be compliant and legal, would provide a moat, but it is moved very quickly. And so we think that there's now more of a risk of that than before. And then likewise, and Salesforce has suffered from this as well, there is clearly a deferral in corporate software spending that is taking place. I think in the case of Adobe, it has to do also with the disruption, but it's also overall investment spending, in particular in the US, but also elsewhere. So from that perspective, we do think that there are greater threats to the company, and we've decided to now sell the remaining roughly 2.2 position that remained over the summer. And what we've done is we've invested in SAP, where we think it's a tremendous long-term opportunity. It's a company we've been following for a long time, both in terms of the underlying business and in terms of the investment thesis on our watch list and then on our approved list. And so if we turn to the next page, we've just put some points here in terms of a high-level summary of what SAP is about. It's an extraordinary platform. It is deeply embedded in the companies that implement it. Those of us who've had a chance to engage with us know that we talk about Nestle and Project Globe, which started in the early 2000s and took over 10 years to implement. So even a company as large and with as many resources as Nestle is only being managed on a global basis for just about 10 years, based on SAP. So we think it's highly embedded. They had struggled with cloud because it was effectively a server, database, and an application type model. But now cloud is 50% of revenues, forecast to rise to 80% by 2030. So they've, we think, now fully embraced the transition to the cloud. And in particular, as they have better applications, as they're able to transition legacy businesses to the cloud. One of the companies we invest in, for example, bought a large division of a German business, and both on SAP, and it turns out it's as if it was two different applications, given the different original setups and the age of the applications, as they've enabled this transition to be easier. We think that their business will become more resilient. And then because of the subscription model they have, because of the recurring revenues, the higher growth and higher margins and stronger cash flows, we think it's a compelling investment case. And it's added to by the fact that as we think that computing capacity will become more and more important, and as it shifts from the kind of consumer-facing applications that we're now most familiar with to the much more substantial enterprise ones, which have much higher barriers and are more complicated, because companies have to be able to, first of all, create the data, hold it in forms that are accessible for applications, and then use it and integrate it into their business. As all of that takes place, we think SAP is exceptionally well positioned to play a very important role in that. So with an opportunity to buy it at lower valuations, we decided to initiate a full position, funded in part, as you saw on the earlier slide, by a sale of Adobe, and by a trim of some of the other positions. So I think it's an example of how our long-term approach and our active approach works, and how we're constantly looking for opportunities, evaluating them from within the portfolio and from within the approved list and watch list of stocks that we have, to try to take advantage of them as they arise. So that's on the most recent trades and the investment case for SAP. If we just move forward, I now want to just touch a bit on the shape of the portfolio, and then talk a bit about some of the other stocks that we have, providing just individual updates, and then we will have some time to go into greater depth either on these bigger picture issues or on some of the companies in the Q&A. But one of the vectors that we look at when we put the portfolio together is to want to have balance. Balance in terms of the large drivers, balance in terms of things like geography, but also listing. The companies are all highly liquid. So these are some of the large factors that we look at, but we're also looking to have diverse and balanced sources of growth. And I think you've seen this, those of you who've been following us, but we are looking at some higher growth companies, some that are more compounding or core, and some that are more defensive in terms of their nature. And as you can see, it really is very much a balance of that. It's something we take into account as we are looking to add stocks to the portfolio, because in particular in an environment now, and I'm starting to get into a bit of the larger picture and the outlook, where the large indices, the S&P 500 and the MSCI World, as well as the MSCI ACWI, are really quite fully valued. And there's so many companies that are so large and so concentrated, we think it's going to be more and more important to have a balance of that, but we're able to have large positions in things like NVIDIA, for example, or ASML for that matter, and to be able to withstand the volatility that comes from those kinds of investments by having this balance in terms of the overall growth, companies that can compound or that are more defensive. And of course, one of the things that's happened is that the defensive ones haven't been as defensive to some extent in their sales, but in particular in terms of their share prices. But that's obviously exactly the moment that we're in, where we're seeing some of that revaluation take place. Then just a shift to some of the stocks and some of the things that we want to highlight. NVIDIA continues to be our largest position. We have some questions that I'm also going to go into in terms of greater detail in a moment. But I think the overall point is that we continue to have high conviction in NVIDIA as an investment case, as a company that is providing computing capacity that will fuel the use of data and the application of AI, but also of the metaverse going forward. And what we've just highlighted here, we of course look at some of the large announcements in terms of the capacity that is being put in place. We think that between the hyperscalers, the large digital platforms, and the sovereign players, we can account for far more than the overall demand that is necessary to justify NVIDIA's valuation. The expectation at the Q2 results was that infrastructure spending could reach 3 to 4 trillion by 2030. Some have actually said it could be even higher. It is not necessary for that to all take place in order to justify the valuation, but we think a lot of that will, because the promise is clearly there. We're seeing the beginnings of applications on the consumer side. We're seeing the beginnings of applications on the enterprise side in less essential applications where it's more about data processing and more bureaucratic type of processes, both from what companies say and as well as in individual conversations with people who work in businesses like that. But we're also seeing in some of the big platforms the benefit that it has. If you look at Meta, we think it's one of the key beneficiaries in terms of being able to drive higher engagement, higher usage, better advertising, better analytics to generate the revenue increases that they have. So we think there's lots of evidence that says that these are going to be return generative investments. At the same time, not every investment will take place, and we're as skeptical as anybody about some of the very large announcements that have been made, in particular around OpenAI. We can go into detail around that, where it is clearly a question about how much of that is going to actually be funded. But again, we think that it's not necessary in order to justify either the case for computing capacity or data, or indeed the case for NVIDIA's GPUs. Meanwhile, we think the valuation continues to be very attractive despite the strong share price performance. And then just to touch on a couple more topics that I think are interesting that have also come up in conversations that we've had with investors over the last weeks and months. One is really to talk about US pharma. We have been very conservative in terms of our exposure there. the overall cost base of the US healthcare industry, the 7% cost inflation, is one of the key reasons why US public finances are unsustainable in the long term. And if that can just be reduced, that growth in healthcare costs, to something like 3 to 5%, so still GDP plus, it would effectively balance the books over the long term, given the strong underlying US potential growth. So President Trump has taken straight aim at that. I think he has support from a lot of constituents for that, and it clearly is shaking things up. The Pfizer deal is very significant. The idea of most favored nation is relevant. The idea that higher drug pricing in the US that potentially pays for drug development should not be in some way offset or subsidized by lower drug pricing elsewhere, in particular in places like the UK, where there's a single payer and where therefore there's a very significant price negotiation. And so regardless of how exactly that will play out and how it will be implemented, we think that it's a really very serious issue. We think it will increase overall demand. It will clearly reduce pricing. It has an incentive to increase US manufacturing to avoid some of the tariff-related measures that are being put in place, which I think in the long term will play to the strengths of some of the global pharmaceutical companies. But it's clearly a very significant shakeup, and the way these deals will take place, I think, will be really a big question over big pharma. Our exposure, if we move forward, is in Roche. It's the one large pharmaceutical company that we own. It's a mix of exposure to actual ethical pharmaceuticals and to diagnostics. Medicaid, as you can see here, is only 2% of its sales, and capacity utilization in the US is under 50%, with significant capex that they're planning to spend, in part in response to the demands by President Trump and his administration. These are all things that are eminently affordable. But the most important thing that comes out of the analysis that Zixin Shu has been doing is that we are very positive about Roche's pipeline. They've had a patent cliff from their significant strength in cancer-related drugs, but they're now moving with a very attractive pipeline across a number of different indications that we think has significant potential, and as you see here, also has very significant potential in terms of $3 billion plus drugs, so proper blockbusters that are moving into phase 3 over the next 12 months. And so we think that at the extremely low valuation that Roche is trading at, supported by a strong dividend yield, it's currently in a very attractive place. And then moving forward to talk about another issue that we've highlighted is consumer stocks. You saw the performance on a year-to-date basis on the stock price charts. You also saw the chart ticking up in terms of the active return and the stock selection. That's from a number of these companies. LVMH and Nestle in particular have had very good numbers. The stocks are up 10, 13, 16% from really low valuations that are big discounts also to their long-term trading ranges. And we think there's tremendous turnaround potential. I think the strongest you can see is in these LVMH numbers, but you see it's turning around in Diageo and Pernod Ricard on the spirit side as well. It's also turning around in Walt Disney, which we think is a medium to long-term, very well-positioned company that has also been held back by concerns around consumer spending. Clearly, what happens towards the end of this year is a question. There will be some spillover and some higher inflation that could lead to market volatility as we look into the fourth quarter. That could also lead to an ongoing concerns around consumer spending. But we think that they've really bottomed, and this question of whether it's a function of incomes or whether it's a function of preference or it's a function of the product innovation, we think it's being answered positively in the direction of a cyclical issue that is taking place, not a secular one, and therefore a significant turnaround potential in terms of the underlying businesses, but also the valuations, a real opportunity right now. And as Jerome highlighted, if we move to the next page, we think that having strong managements with a track record of value creation is a key attribute of quality. That's also not always the case. As you know, we don't exclude, we look for fundamental characteristics in terms of the way we integrate ESG analysis into what we do. But where there's a problem and where we think that the quality of the underlying company prevails, we actively engage, and it can also be a source of opportunity. So we're active investors. We will be as active as we need to be without being activists. In September of this year, Nestlé really has come to a turning point with the issues by the former CEO, who has been engaged in an affair with a subordinate that was inappropriate in terms of the corporate governance of the business, and also inappropriate in terms of the way that he disclosed it to the board when questioned about it. We were not pleased with the dismissal of the previous CEO, Mark Schneider. We voted against Paul Balke, the long-term chairman, at the last annual meeting. We go through all of the proxy voting ourselves, so we take a very active view in terms of the decisions that we take, and we decided to make some public statements around the viability of Paul Balke's continuing as the chair of Nestlé, and the need for him to hand over sooner than had been announced to the designated successor, Pablo Isla, the also long-term board member and long-term senior independent director, but also former CEO of Inditex. We gave these comments in September, and within a couple of days of the Financial Times interview, which I think was one where we, along with some other large investors, called for Paul Balke to step back, that actually took place. So I think it's an example of active engagement, and it's also an example how a committed long-term shareholder, even if by comparison to the global investment industry, we're a boutique investment manager, our views are serious. They are based on long-term commitment and analysis to the companies, and they're also taken seriously at the highest levels of some of the companies that we invest with. So it's something that for us is part of stewardship. It's why we also participate in public discourse like that, and it does show that long-term investors can have a positive impact. Nestlé performed as strongly as it did because we've actually had a very good start by Philippe Navratil, the designated successor. We think that he has a very promising profile, and what he's talked about in terms of reinvigorating growth, being more conscious of costs, the 16,000 people layoff to manage costs in this challenging environment, and at the very least the openness to taking measures around the portfolio was very, very well received by investors, and we think it's clearly just the very beginning of a turnaround there. And then just to touch very briefly, I think, because we want to leave time on for Q&A on some other stocks. One thing is Diageo, this globally leading spirits company. It's clearly had a significant issue around consumer spending, around the question of whether younger people are cutting back on drinking, on the question of whether GLP-1 would have a significant uptake, and that would lead to a reduction in the potential demand. All of that is true up to a point, but we think far more important is the squeeze on consumer spending from the inflation and the interest rates. Again, it may carry on still into the fourth quarter of this year, but there's a real sign there of turnaround, where the organic sales have started to turn around, where they've held or gained market share, whether they've been able to maintain market margins in part because of cost cutting. And so we think that with some of the changes that are taking place there, they are able to, they're going to be able to deliver a turnaround, and that at the current very, very cheap valuation, both on our absolute numbers and on price to earnings ratios, it is a very significant opportunity. And likewise, LVMH just reported strong numbers that showed a return to growth after declines that have taken place. And we think that it's really, again, an issue of consumer spending, of the inflation and interest rates, but also the fact, and it's something true for LVMH, but it's also true for other companies, a slowdown in investment in advertising and promotion and in innovation as a result of these squeezes, and now a much better perspective going forward. So we're positive in terms of LVMH because of the recovery and the self-help that it can have. And again, it's trading at attractive valuations. And then just some final points, I think, on the bigger picture. If you look at valuations in markets, I was alluding to it, we think that the S&P 500, MSCI World, MSCI ACWI are now really quite fully priced after 10 or 15 years of strong performance in a low interest rate, low inflation environment. That is now coming to an end. Whether you look at the Magnificent Seven, and you can see we actually own 4 of the 7. If you look at, I think more relevantly, the top 10 or 15 US tech stocks, or if you look at the US stocks with market caps of 500 billion or more, we've highlighted some of them here. A lot of them are very fully valued, or we think overpriced. Some of them that are high quality are on our approved list, like Costco, for example, or Walmart, and we would love to buy them if they were at lower valuations, but they're not. Whereas we, and I think it's very clear from the highlighted stocks here, have stocks that are at much lower valuations, or at least lower valuations compared to the very significant growth that we're expecting. That's in particular in the case of NVIDIA, as you can see it there. So it really ties into what I was saying earlier in terms of saying that we think that our portfolio of stocks that have high potential growth to deliver, but that are either at reasonable valuations, in many cases discounts to the overall market, or that are valuation gaps of 20 to 40% or more, are a real opportunity for investors in this environment. And the question, of course, is that after this 10 or 15 year run, indices now with more full prices, the time to invest has come to move away from passive to invest in active investment management, because we think, and as we're arguing, as we're highlighting with this data, stock selection and quality and valuation are going to matter a lot and a lot more than they have. And then just as a final point with some data, because it's been something it's been come up in the conversations with investors, is what about the AI bubble? And we don't think we're in a bubble. There's clearly some demand for AI that's exaggerated. There will be corrections that will take place and so forth, but we're in a very, very different position. We've highlighted here some of the very largest of the leading tech stocks. Some of them weren't even public at the time, but there's no comparison to the valuations for most of them. The internet was much less proven. These companies were not cash generative, and they were trading at valuations that were significantly higher, leading in part to clearly the irrational exuberance arguments that were being made at the time. On the contrary, if you look at the current period, the valuations are much lower. Cash businesses are cash generative. Even the capex that the large hyperscalers and platforms are investing is entirely commensurate with the cash that they're generating. It's a year or two of cash flow at best. And so these are, we think, a very, very different moment with much more proven business models. And therefore, we think very significantly lower risk because unless you are in a situation like with Tesla, where the valuation is extremely high, there's already a lot of valuation support for these businesses. And therefore, we think there's going to be resilience when there is inevitable volatility around these issues. And it's, again, something that we think is simply not compatible, even as we have to be conscious of the potential risks from the very large scale up and the announcements that we're seeing. So that really brings us to the end in terms of the outlook of what we're seeing. We continue to be constructive as we look towards the end of this year. The main thing that we see is that in this environment where in aggregate there's been solid underlying growth, where inflation has been, for the most part, moderating, and where the Fed has been cutting, in part because of decisions, in part perhaps because of pressure from President Trump. There could be a pickup in inflation as inventory now has run out, and as goods bought with the incorporating the tariffs are going to be passed on. We have to be prepared for that, but we think that the underlying picture continues to look overall robust. There's clearly a Fed that is looking to support the overall economy, and even as there's been weakening in the U.S. job markets, and aggregate household balance sheets are really quite robust. So we think that there's reasons to be optimistic going further. We think there's going to be support. There may also be considerations around U.S. midterms next year. Not all volatility and uncertainty is negative, because some of the global conflicts may and hopefully will be resolved, which should be a positive as well for sentiment and for business. And our strategy does best when companies can go about their business. An environment that we were anticipating for this year at the beginning of this year, and an environment that we think is likely to come through as we look forward. And so therefore, we are constructive about the outlook for our companies, but as I just said, and I hope highlighted with some of the data, we do think that U.S. equity markets are concentrated. We do think that they're fully valued, and we think therefore stock picking is going to matter more than ever before. And of course, that's what we do in our global portfolio of stocks, with the attributes that it has, and the quality and the valuation that we look for in the companies we invest in.